Okay, we are going to go ahead and get started. My name is Sarah Tortella. I am the program manager here at the Master of Agribusiness program at K-State. Today, our presenter is Dr. Brian Briggeman. He will be presenting about the impacts of changing interest rates and talk to us about what's happening in our current environment. Dr. Briggeman joined the faculty here at K-State in the fall of 2011 as an associate professor of agricultural economics. He is also the director of the Arthur Capper Cooperative Center. Dr. Briggeman earned his bachelor's degree in agribusiness from K-State in 2000. He received his master's degree in agricultural economics in 2002 from Texas A&M University. And in 2006, he completed his PhD in agricultural economics at Purdue University. Prior to K-State, Dr. Briggeman worked as an economist for the Federal Reserve Bank of Kansas City, Omaha branch. I am going to turn it over to Dr. Briggeman now.
Okay, Sarah, are you able to see that?
I am. It looks good.
Okay. All right. Well, good afternoon, everyone. Thank you, Sarah, for that introduction. I've prepared a few slides here for you all to kind of get the conversation started about the macroeconomy, interest rates, inflation, to kind of go through, how did we get here? What are some of the key issues that are driving the current situation? Also start saying like, well, where are we going? What does the future, hold? And then to start thinking about, well, how do we manage through this turbulent time? So I put this together in a way to, kind of keep the conversation, at least for my prepared remarks, fairly short. So I want to answer questions. I know we'll have some time at the end, certainly for Q&A. But if anything comes up, feel free to put it in the chat and we'll address it here as we go through. But to start off, I think whenever we talk about the macroeconomy or think about interest rates, what's top of mind for everyone is the rising or sharp rises in inflation that we are currently seeing. I mean, for the first time in a very long time, the average US consumer sees inflation in the headlines, and it's being widely talked about, arguably for the first time since the 70s. And if we look at just various measures of inflation, here looking at the personal consumption expenditure price index, you can see our headline index and also the core index. So the black line is the headline. That includes all bundles of goods that are included. And then on the core, the red line, we strip out the more volatile basket of goods of food and energy, just to kind of see where that's pushing. And regardless, whatever measure that you use, it's pretty clear here where we're at today, it's up. But it's not as high as what we experienced in the peaks in the 70s. And I think that's important to note that, yes, we have seen inflation going up, but it's definitely not where we were at in the 70s. Now, could it continue to rise that high? I mean, certainly everything's on the table, and that's possible. But there are measures being taken place right now to where to try to get it under control. And in fact, when we look at the core, some of the more recent data, it looks like it might be potentially leveling off somewhat. A lot of that is just kind of responses to the Fed's reaction to this inflation to try to get it under control. But we do see certainly, when we go to the gas pump on the energy side, we go to the grocery store, food. So that headline inflation, what the consumer sees within the US is definitely up. And it looks like that might continue. But how did we get here? How's this going to be resolved, with regards to inflation and thinking about going ahead? Well, really there are kind of two camps of arguments when we talk about inflation. We have supply side arguments, right, where we look at different bottlenecks, that have occurred within our supply chains, stemming from, the pandemic and the shutdown and things within the Suez Canal. Even back then, there's been significant disruptions on just the supply to it, again, stemming from the pandemic. Energy, we've had some different things that even happened here within the US as far as our approach under the current administration when it comes to oil. That has had an impact as well. And also too, looking at how OPEC and they handle the supply side on oil. That also has put inflationary pressure. And then when we look at the Russia-Ukraine conflict, there are numerous stories out there about showing its effect and potential impact on food prices. So there are plenty of supply side arguments to build up for that inflation increase. Now let's flip on the demand side. One, coming off the pandemic, we have a lot of pent up demand. I don't know about you all in your household, but my family, we've traveled a lot more. There for a year and a half, we really didn't do much traveling, but now we're ready to get out, ready to go and do different things, to spend those dollars. And also too, here we've seen pretty significant real wage growth, wages that we haven't seen rise in quite some time. So that certainly helps to stimulate, on the demand side to pull that inflation up. But also too, the last round of stimulus that we received in 2021, many economists, I would include myself in this camp, it was too much, had too much stimulus to be pushed out into the marketplace. And certainly that can create a situation where we have additional amounts of inflation. And then finally, we've had favorable monetary policy for a number of years. So with very low interest rates, quantitative easing that we'll go through here in a little bit, all point to that demand side for an increase in inflation. And in fact, for many, many, many years, the Fed was trying to create inflation. So there are arguments in both camps. And, how do we get here? What's driving inflation? We're in a situation where it's both, where we have supply arguments, we have demand arguments, both of which have led to that really sharp rise within inflation. I see on the chat box here, I got a couple of questions, and I might go back and I'll just go ahead and stop here and read it out loud. Sarah, is that okay if I do that?
That is perfect.
Okay, because I don't think you can see the chat box already. So a question is, I've heard in the news that we don't use the same formula today that we used in the 70s for inflation. Is that true? I don't know exactly what that news report was tying to, but if we look back over that time, that personal consumption expenditure index, the graph that I just showed, it's consistent over that amount of time. So it's trying to use the same bundles of goods at that time. So now, do some things maybe go in and out and they try to find substitutes? I'm sure that happens. But I think it is comparable across time on that PCE index that I showed earlier. The next question is, what % of the current inflation was caused by increased money supply or by COVID stimulus payments or by holding interest rates too low for too long? It's difficult to pinpoint an exact percent of that, the inflation, like I showed here before, so right here, looking at this big rise up, how much of that caused this big increase? Well, if we go back and look at what occurred in the financial crisis, we actually had that fall into a deflationary environment, and we flooded the market with, quantitative easing and stimulus, putting low interest rates, and we never really got traction. I really think probably what this is causing or what happened here is a unique situation where we had the pandemic shut down our economy. You had all these pent up demand, a rush to push stimulus into the marketplace, and we also had supply chain disruptions. So you had supply and demand, all of that kind of culminating in this big increase. And I do feel that that stimulus was too much, especially those $1,400 checks that went out in 2021. At the time, I was like, this is probably going to be too much. And now we're seeing some of those results. I think it's important to also make note of, what were some of the lessons that can be learned from the 70s inflationary environment? Well, it wasn't like all of a sudden, in 1973, 1974, we just woke up and had 12% inflation. Well, it was a series of policy missteps that occurred during that time in the 60s and then the early 70s. And then you had the supply issues coming from, with oil and the gas lines that occurred. And then we also switched from the gold standard, to a fiat currency system. So there was a lot going on at that time that all of a sudden caused that big inflation. So you have like this buildup that occurred after the financial crisis, having very low interest rates, quantitative easing, and then the pandemic hit, and then you have supply chain disruptions, and then boom, we have that pop. So the future of looking where it's going to go, how high could that number get? Well, it's a really good question. I mean, if I was to look at my crystal ball, I could probably make arguments that, well, maybe we will see what it was in the 70s, or arguments to say, no, it will get under control. It's something that we'll have to monitor, but to say like an exact percentage amount, it's difficult to say. I think it's just a culmination of everything that's occurred up to this point. Thank you for the questions, and keep them coming. I'll try to pick up on them as I kind of go along. Okay, so we're here now. So what do we do, right? So clearly, I think if you follow anything at all in the news, the Fed has pulled a page out of the book of Paul Volcker, who was the Fed chairman during the 70s when we did have that really high inflation. And he showed us what to do to fight inflation is you let interest rates rise. You let them increase in order to cool the economy and to try to get inflation under control. So that currently is what the Fed is doing. Many are expecting the Fed funds rate to get up to around 3% by the end of the year. In fact, the last rate increase that we just had was higher than expected here in late May, June, by being 0.75 basis point increase, or 0.75%. And that really threw the market into a tizzy. And I think it's important the point to show is that we're coming off of the zero bound. So this shows the effective Fed funds rate. This is the interest rate the Fed directly controls. Technically, it's the rate that banks lend to each other overnight, but it's the primary monetary policy tool for the Fed by saying, if we're going to let interest rates go up, we're trying to cool the economy or get inflation under control. Or if we lower them, we're trying to stimulate the economy to avoid either a recession or to get out of a recession. But when we look at the effective Fed funds rate, where it's increasing now, where it sets here, it is substantially lower, even from where we were at going before the financial crisis, and certainly well below where Chairman Volcker allowed the Fed funds rate to get up over 18%, nearly 20%. And this little increase, just a small increase, created a lot of questions and a lot of turmoil within the stock market, right? We saw it initially built in a lot of those interest rate expectations with it going down, but then certainly fell even more as there's more uncertainty about, Chairman Powell coming out and saying he will allow interest rates to go up. And if that causes a recession, then they will react accordingly. But he certainly sent a signal to the market that if his whole point and focus right now is to get inflation under control, and if that means letting interest rates rise and that pushes us into a recession, then at least as I read those reports and his statement, sounds like he is prepared to do that. So if we think about, these rates coming up, we're still at a very low rate, but it is having an effect within our economy. See a question come up in the chat here. Okay, so which do you see having a larger impact on cooling inflation expectations? Raising the Fed funds rate or the Fed changing their bond purchase program? Right now, the way I would respond to changing inflation expectations, or to try to get the market to understand, or probably even more so for the consumer, I think it's probably an equal balance of both. Right now, the Fed is using the interest rate because it's the most clear signal to send to consumers. The average consumer that's looking at that inflation headline, they more quickly can grasp the concept of interest rates. But I do feel the Fed's balance sheet, or quantitative easing, which you're referring to on the bond purchase program, has, I would argue, almost as important of a role as interest rates, which is actually the next slide that I have to consider. Well, what's the Fed doing on quantitative easing to try to get inflation under control? So to go through this graph and to kind of bring this back to inflation, there are really kind of two things that I think need to be talked about to really understand like what's going on here with the balance sheet. The first is looking at the size of this balance sheet, and then the second is the composition. So let's first go through the size. This is the the Federal Reserve System's assets that they hold. So when we talk about the Fed balance sheet, we talk about the assets that they hold. So we have the red area, our mortgage-backed securities. We have some liquidity to key credit markets, some lending that goes on to financial institutions, the long-term treasury purchases, which is the bond purchasing program mentioned before in the question, and then just traditional security holdings. Well, before the financial crisis, if we look all the way over here at the left, under what we might consider a more normal functioning US economy, the Fed had about 850 billion of assets that funded their activities, right? The Fed is autonomous from the US government. In fact, the way I like to think about the Fed is they're a for-profit institution. They're just for-profit for the US Treasury. So any profits that they make from the services they provide or tradings that they have, those earnings go right back to the US Treasury. But in the financial crisis, the size of the balance sheet jumped up to over 2 trillion. Many of us were wondering what in the world is that going to do? Then we had additional amounts of quantitative easing that pushed us closer to 5 trillion. Then the pandemic, now we're up to nearly 9 trillion in assets. And if we think about the way our economy is set up, well, before we haven't grown that much as in terms of total amount of the economy, so 850 billion was enough to navigate it. Now we're up to like nearly 9 trillion. So the size of that is massive. It's hard for me to fathom and to think about $1 trillion. So this isn't in the slides that are out there, but for those who are viewing the presentation, I like to just kind of go through a little quick thought exercise to kind of put into perspective, like what does $1 trillion look like? So this is a $100 bill. I think some of us have an idea of the concept of that, right? Just bill, $100, fits in your pocket real easy. If we bundle them up, we can get to $10,000. And of course, $10,000 in that bundle, yeah, you can put it in your pocket and walk around. Nobody would really notice it. $1 million, got a person in here now for scale. It's quite a bit of money. But if we put it in a backpack, the size scale, you would know that somebody would have $1 million around, or if they were walking around with that. We get into a pallet of those $1 million bundles. So now we're at 100 million. Now we're talking about some real money where you need a forklift to move that thing around. $1 billion right here, to see kind of the scale. But it's still, it's impressive. It's $1 billion. But this is 1 trillion, or 10,000 pallets that are here. And if you look over here in the far left-hand corner, here is this person, right, standing here. So this is a warehouse, right? And there are nearly 9 of these on the Fed's balance sheets as assets. So 9 trillion, just to kind of put that into scale and to think about how large it is. So what role does this play? Well, clearly, it would be highly inflationary if these assets could enter into our commercial banking system, right? That actually, banks that are out there could have access to this and loan these funds out. Well, that would really create a lot of disruption. The Fed will not let that happen. So these assets that the Fed has held, like especially the mortgage-backed securities, the long-term treasury purchases, doesn't flow into our normal commercial banking system as we might think. That's important because if it did, yes, that would be highly inflationary. But it does bring the question about, well, what is exactly money then? You know, like if we look at money supply measures, they're all through the roof, so high that you look at inflation and say, yes, I know inflation's up, but why isn't it even higher, right? So there's just a little bit of this quantitative easing kind of creates that disconnect where it creates problems, in my opinion, for the inflation and tempering inflation expectations. And I think the Fed is being very careful with it, the second point I want to talk about is the composition. The first thing to talk about, which the individual brought up on the bond purchasing, is this orange area here, right? So this is the United States government's central bank, the Fed, buying its own government debt, right, or bonds. And if you go back to take macro 101 or look back through any of that, that's called monetizing the debt. When a country's central bank buys its own government debt or own government bonds, it's monetizing the debt, which means you are trying to create inflation. And so for the longest period of time, the Fed was able to do this and not have really rapid inflation. Well, now we're doing it at even a larger clip, and we're really starting to see it come off. Again, kind of the supply, it's that perfect storm. But now here we're at, and I have really wondered why the Fed is so slow to wind this back, right? To wind back this long-term treasury. It's easy to send out that interest rate, but at some point in time, we have got to start unwinding this because the orange area, these bond purchases, it clearly is monetizing the debt. It's creating extra inflation. The other piece composition that for me is just a head scratcher is thinking about these mortgage-backed securities. Why the Fed continues to buy mortgage-backed securities is perplexing to me, especially during this period of time, 16, 17, 18, 19, 20, 21, the home real estate market in the US was doing quite well. And the whole reason the Fed got into buying mortgage-backed securities was back in 2008, coming off of the financial crisis. Chairman Bernanke said the missing piston in the US's economic engine is the real estate market. Therefore, the Fed has to start buying mortgage-backed securities to help support that market. Well, at the time when I was thinking about it, it's like, that makes sense, but the Fed never stopped buying those. And the way I like to think about it, the Fed, the US central bank, picked a winning industry. They chose an industry, the real estate industry, and they've continued to support it throughout. So why the Fed didn't take the opportunity to start winding this down sooner is a little perplexing to me. Certainly, they've always had some mortgage-backed securities in the past, even before the financial crisis, but not nearly to this magnitude. And I think this creates, just this, the liquidity that comes from the mortgage-backed, security purchases the Fed does from the, buying those bond demands in many ways that creates almost like an addiction, if you want to think about it that way, for that liquidity, for that quantitative easing, the money that's flowing through. At some point, this has to come raining in. And the easiest way for the Fed to do that is to stop those programs, to stop reinvesting those funds as they did for so many years, where a security would expire. They would take those funds and just reinvest it back into those securities. So I think here pretty soon, the Fed needs to start doing that, start winding down that balance sheet to get it off of that 9 trillion mark, which should help temper some of these inflation expectations. I think would help, the interest rates going up to bring it down. Okay, so here we got another question in here is it even possible to reduce the Fed balance sheet to pre-COVID levels without a recession? It's a good question about can you actually get it without a recession? If you're asking me that if we're going to, it would take years, right, for us in the most, or how should I say this? The less disruptive way to get this from 9 trillion down to the 1 trillion mark is to stop purchasing new securities, stop purchasing new bonds. When it expires, and we let that happen naturally, which would probably take, could take about 10 to 12 years. Well, I think once we kind of open this up and we're continuing, the Fed has shown that they're willing to do this, it's going to be, I would argue, much, much longer than 10 years for us to get down to a pre-financial crisis level. And if they were to really rapidly adjust this down, without question, it would create a recession, might even create a global financial crisis, because the US is so prominent in many of these markets, and the Fed clearly is buying and providing a lot of liquidity into that market. It would really be hurtful. So if, yes, you're right, if they were to adjust it rapidly, it would create a real significant recession, in my opinion. But if they let it unwind and let it, kind of go down naturally, that could be a best case scenario. What are the odds of that? I'd probably put it pretty low, because I do think once, like we do hit into a problem, when does this stop? And that is something that we'll have to continue to monitor. And I wish I had a better answer about when this will occur. But I do think it's an important part for tempering inflation expectations and getting us back to kind of a more stable growth pattern. Okay, so what lies ahead, 2022. So thinking about on mind, I mean, just the last question brought up about recession. So here are a couple of items that I'm looking at, that maybe point to we will not go into a recession. Some good signs that the economy is starting to recover, and that will continue to do that. Okay, so for the US economy, 70% roughly of our total gross domestic product comes from consumption. So that all ties back to the labor force and people working and generating income. So they have disposable income and can go spend. And certainly coming off of the pandemic, labor markets were significantly disrupted. And so unemployment rate currently is at 3.6%, but one factor I like looking at is the labor force participation rate. So looking at that available labor force that's out there that, is actually actively working. And we can see, kind of some of the trends, where we had that labor force participation rising pretty significantly, with the baby boomers, coming back and working. And we see that labor force participation quite high, but then began to dip off. And then certainly from the financial crisis, we had, big retirements and folks leaving the labor force, but we started to see it start to trend up. But then with the pandemic, with it shutting down, unemployment insurance, stimulus, numerous things, people not comfortable going to work, went down, but it's starting to pick back up. And with the real wage growth that we've seen, with people having pretty good opportunities for jobs, my forecast for labor force participation would be for it to continue to rise. So I think the labor market is healing, is starting to kind of move past, and it's certainly once the extra stimulus that was pushed out goes away, then we'll continue to see people coming back to work. And all of that leads to, good things for consumption. Here on the right-hand side graph, I have for retail sales, and just looking at the year-over-year change for retail sales. I like showing this because you can see how significant the dip down in retail sales was going through the financial crisis, down around negative 10%, but how quickly and sharply down the pandemic caused it down to negative 20%. And then here's that pent up demand, right? Where we had a real strong snapback, and we still are maintaining that pent up demand. We're still seeing retail sales on a year over year basis are still strong. Now, the newspapers and Wall Street Journal and others really follow a lot of that month to month. And if we remember here, just here this past May, The headlines were May retail sales fall. I think it fell about 8% month over month. And people pointed a lot to, well, it's inflation and, concerns about the economy. But I like, that might be a temporary thing, right? If we get those expectations under control, why not look at where we're at on a year over year basis? So consumption, I think, is coming back. And these two things taken together are a good thing. Maybe we can avoid that recession. But here are a couple of items that I think we have to look at reality and say potentially a recession is going to happen. So what are some of the bad signs that are out there? The University of Michigan Consumer Sentiment Index that I have here on the left is in incredibly low territory. If we look at, how U.S. consumers, are generally their sentiment towards the economy and where they're at, we're in, levels that are very akin to the financial crisis of 2008. So that's quite low, with the negative headlines that are out there driving a lot of that makes it, pretty concerning where we're at. So are these going to become, expectations that actually lead us into a recession, the consumer not feeling comfortable? On the other side too, something that has been of great benefit to many homeowners within the US is these low interest rates push down, mortgage rates to very low levels, so a 30-year average fixed mortgage rate, coming off of the pandemic got down to around 2.5%. But now we've seen that average rate jump up to nearly 6%. So there's a lot of discussion now about the cooling of the housing market, a lot of that wealth that was felt through that. Could that be an indication of consumers beginning to really, start pulling back? So taken on balance, when I think about, the recession, are we heading to a recession? People ask, hey, are we going to do that? Well, obviously I don't know. But if I was to say, put a percent chance that we're going to fall into a recession here within the year or over, this time next year, it's probably at about 35% is what I would say. I think there's some good signs. There are some things that are occurring that can help us avoid it, but there definitely are some negative items that are out there that we have to recognize. But I wouldn't put it into it's a likely territory in my opinion, or a likely thing to occur in my opinion. So I'd put it at about 35%. So what lies ahead for ag finance? I know many of us, work within agriculture. So to build off of the mortgage rate increase, I took these graphs that you'll see here, a couple of them from the Ag Finance Data Book that the Federal Reserve Bank of Kansas City monitors and puts out on their website. It's a great resource if you're interested in this kind of thing, so feel free to go there. But looking at, across the different Fed districts, looking at average fixed rates within agriculture and ag banks, we're beginning to see those increase. And I think when they get there, this is for Q1. I would imagine for Q2, we would continue to see that rise. And why that's really important, many people always ask about, well, what about farmland values? Where's farmland going? So if we look at the most recent information on the first quarter of 2022 for non-irrigated cropland values, again, coming from the Ag Finance Data Book, we can see that it's quite a bit up, right, over last year for first quarter 2021. So we've seen, pretty significant increases. And so could this rising interest rates really dampen farmland values? It might create a bit of a, maybe of a plateau or kind of to slow those increases. It could create some demand issues if an individual is going to sell some farm ground and, the individual wanting to buy needs to borrow and interest rates are quite a bit higher. Well, that might create some demand issues. But I think the big thing to keep in mind for agriculture, just in general, whether, what drives farmland values and helps drive our health going forward, is to think about incomes. So if we look at, U.S. net farm incomes and net cash farm income here from USDA, we're still quite a bit above the 2001 to 2020 average in both a net farm income and a cash perspective. Not as high as what we saw in 2012. And again, this is on average, but still fairly elevated. And I would probably push back a little bit on the USDA for what they forecasted for the 2022 forecast. At the time when they released these forecasts, of course, what was dominating the headlines was high fertilizer prices, input costs are rising rapidly, but what nobody really foresaw was how much commodity prices were going to skyrocket on the revenue side. So maybe after some readjustments, those might even come up. We do have some things here within the Department of Ag Econ here at K-State. The Kansas Farm Management Association and some of our economists here do some, hold on here just a minute. Excuse me, had to cough. Didn't want you all to have to hear that. But when we look at the Kansas average net farm income for what occurred in 2021 for our KFMA members, it was on average $310,000. And if we look at that 10-year average, the 10-year average is $124,000. 2021 was a great year, right? And if we look at 2022, even though we have these elevated, crop input prices and feed prices, we're still looking at an average forecast within Kansas of $291,000. So those incomes being elevated like that, especially here in Kansas and even across the US above, those longer term averages, still holding strong. So if I was to say, what do I expect within the farmland market? Well, I would imagine it would still hold up because we still have those net farm incomes. Now, 2023 and beyond, that's a good question, right? We'll have to wait and see how the conflict in Russia-Ukraine, unfolds, how supply chain disruptions. Does the US actually go into a recession? Right now, the US dollar is extremely strong. How much is that going to affect our competitiveness in the global marketplace for that? I know you look across the world and, certainly some of the supply issues, Brazil going through a drought, that they had that, are we going to be able to fill that? And regardless of the strong dollar, we're still going to be competitive. That all very well could be. But as we monitor the situation, looking at incomes, I think is a really important story. And right now, as we look across the US, it looks to be fairly positive, at least on average. Of course, there's going to be cases, that certainly will be challenging. There's a question in the chat. I'm going to go here. It says, speaking of incomes, might there be an effect from off-farm incomes on the farmer, farm family, farm balance sheet? Of course, I'm just looking here at net farm incomes, but we know many of our producers that are out there have other off-farm incomes or, other, non-farm assets that are benefiting them. Certainly, there can be an effect. I think the concern that I would have would not necessarily be so much the US going into a recession. It's just more, will we continue to have people living in rural areas that we can continue to have those options available? Of course, there's remote work and we can do those different things, but from an off-farm income and viability standpoint is, are we going to be able to maintain those rural populations to where, those opportunities do exist and we're not having to drive great distances? So could a recession impact it? Absolutely, especially if you're working in town, like a larger city, and they do have layoffs and they do pull back on the labor force. But I think it's probably, at least as I would look at it, more concerning just to think about rural populations and how do we make sure to have those off-farm jobs, not only for, farmers, but also for those folks that live in those rural areas. So all of this to lead. So how should I position myself? And I get this question a lot, how do I position myself, enter my business, farm, to navigate higher interest rates? I think that's pretty clear. Interest rates are going to keep going up. So how do we position ourselves for that? Well, the first thing that comes to my mind, and this is more from a personal standpoint, we have generations of people that have never experienced inflation like this ever. And I would probably include myself in that. I was born in the late 70s and, I remember mom and dad talking about it, but I've never really experienced rapid inflation or significant inflation until now. So there's a whole host of people that just don't know. So there was an article I was reading last year in the Wall Street Journal, and there was a snippet here that I thought was pretty good, and I'll share it to you because I think it goes to a really key point that all of us, working with whomever, need to kind of take this to heart. So the story centered around a Washington, D.C. resident. Her name's Jordan Berry. And one of the things that she said was, noticing like how things are getting, as she put it, the amount of money I'm spending right now is kind of ridiculous. It does make me nervous. So she recognizes something's going on. But it's this highlighted quote that I think really kind of stood out to me, where she said, I literally went to Whole Foods and Trader Joe's recently, and we spent probably the same amount of money and got a lot less things, right? So kind of really, like the food packaging, like seeing like how that's maybe gotten smaller and spending more money and getting less food or whatever items she's buying. She's kind of starting to see, well, how do I need to make an adjustment? One adjustment I would say, if you're not familiar with Whole Foods, and Whole Foods especially, it's a fancy grocery store is the best way that I can describe it. Pretty expensive, kind of exclusive. Trader Joe's, there are some pretty good deals actually that you can get at Trader Joe's. So first piece of advice would be, well, maybe shift more to Trader Joe's and looking for other, maybe more affordable places to purchase food. But the bigger thing that I took away from this, and generations of people need to have a better understanding of how to complete a budget. How do I focus on a budget from a personal standpoint that I know this is the amount of money coming in, these are the bills that I'm expected to pay. I need to maintain and stick to a budget. And I think that whenever I think about, people ask like, well, how do you do an inflation workshop and how would you go through it? Probably one of the key things to walk away with is, how do you budget? How do you manage your own finances? And when you're going through a period where it's a little bit tight, how do I make sure that I'm still saving and I'm, building up and making sure I stick to that budget? And that goes personal and even goes into business. But, I think that's an important point that many of us need to work with, maybe within our own selves or with family members or clients or just people that we generally come in contact with. The budgeting is really important. Look here on a question on, does net farm income include SBA loans, farm government payments, etc.? Yes. So that graph that I showed before, when we think about, especially here in the Kansas net farm income, that 310,000, a lot of that is driven up by whether maybe they had a PPP loan or also could have those government payments. So a lot of that helped to build up. And I think that's a really good point and a nice segue that builds off of this idea of budgeting is, well, what do you do with that extra money, right? From a business standpoint, do we go out and spend it? Because it's temporary, right? There's no guarantee it's going to be there. Well, for farms and agribusinesses to, I just can't say this enough. And I've been saying it now, seems like for years, but it's so true. It's the blocking and tackling of business, right? Of how you run your farm, how you manage your agribusiness, how many farmers were able to get through the 1980s and how turbulent it was. Just tried and true, important things. It's not some fancy, new business strategy, but things that just, they work and you focus on it. So with that extra money that would be coming in, whether from government payments, whatever, the first thing I would tell farmers, build your balance sheet. Find ways to increase your liquidity, build up working capital to where you have those funds available. So if you do hit a tough, difficult time, you have some really, liquid assets that you can get to. But also to use debt wisely. I think there are plenty of opportunities out there in order to expand operations, and I think debt is feasible. Many of these farms and agribusinesses are going to be passed on to generations, or they're going to continue on well into the future under a board of directors guidance. Debt can be a very good thing, right? It can be a cheaper form of capital in order to help finance the business. But focus on that balance sheet, build it up, increase liquidity, and use that debt wisely. The other item to bring up, how should you manage this time, is just to be extremely efficient. from an operational standpoint. Just pour over your operations, look for efficiencies, look for things that if we did things maybe a little bit different, if we got rid of this asset and replaced it with this, or maybe we should lease, or maybe we should buy or rent, whatever it is, how can we enhance operational efficiency and then control your costs? Classic adage is farmers are price takers. So one of the things that's within their control is, how do we manage our costs? But that does come with, a caveat of don't manage your costs to a point that you miss out on quality and miss out on, whether it's a different type of seed genetic or a different type of spray application or something that might cost a bit more, but at the end actually leads to a larger volume or a larger, profit for the operation. So control the cost, control that piece to a certain extent, but don't forget that, agriculture is an expensive business to operate. We need to control our costs, but we have to make sure, that we're continuing to operate. And then finally is don't forget about opportunities to expand. I mean, through this type of environment, things are going to come up and you can either improve your farm, your ranch, maybe there's an acquisition if you're an agribusiness that's out there that you weren't expecting, but if you've gone through and built your balance sheet and you're very efficient, maybe it makes sense to bring that on, because I still feel in each individual local market, opportunities are going to come up and you should be positioned in order to take advantage of those. So with that, those were the prepared remarks that I have. I'm just going to stop share here. And Sarah, I know this is the first MAB webinar I've ever done. I know I've kind of taken questions as I've gone along, and there's been a lot of good ones. So Sarah, do you turn it over and let people ask, or how does it work?
Yes, at this time, if anyone has any questions, we have about 5 minutes for questions. You can either ask in the chat box or you can unmute.
I'm really good at awkward silences, especially, when I don't have to stare at faces in a room.
Maybe, hey, this is Mike. Maybe here's a question. Let's say you're a young farmer looking possibly to expand in the few years here. What would be your recommendation if you have like long-term debt on land versus, maybe an operating note? Where do you think if you had cash to, pay down maybe long-term notes, what would be your recommendation just with interest rates and everything?
Yeah. Well, I mean, of course, it's on an individual basis. I mean, the thing that I would want to look at for the farmer is, well, what's your interest rate on that longer term note? When did you finance it? Because there were some really appealing financing rates, in late 2020, early 2021. So if that's the case, then maybe those funds would be better spent building up the balance sheet, especially if you're a young producer. Working capital is so important. Number of farmers that I talk to, they always, they always point to that we need to make sure we build that up, because that's one what makes your banker feel better, right? If you've got a good, strong working capital liquidity position. So maybe that is retiring a bit more on the operating loan. But it would be a balance between the two. So to me, I know everybody wants to get out of debt, and I have this conversation with my dad all the time. But you know, the farming operation is going to be around for a very, very long time, and debt, especially long-term debt, is a good thing. I mean, if it's used within reason and you've got a good locked-in fixed rate, build up that working capital position, because that's really important.
Are there any specific commodities that drive, that could drive a recession, increase or decrease in oil costs, fertilizer, et cetera, that a person should keep an eye on?
Yeah, I think from a US standpoint, while the Fed has very little control under, if you remember that headline inflation number, because energy is in it, it's probably one of the ones that matters the most for a recession, because everybody's, when they fill up their vehicle, they realize how expensive it is, and how, much it eats into their disposable income, spending on other things that they want to do. So from a commodity standpoint, I really think, the gasoline prices, that does matter a lot. But in the US, when you look at things like food items, we're a very developed country and a very rich country. So the amount of money that we spend on food, at least on average for the average consumer, it's very, very low. So for me, if I was to point to a commodity, I would be following energy, just to kind of see how that develops, and not even so much like the actual price, but where is supply? What's supply going to happen? Are we going to see more come online, in the future? I think that's a big factor there. See the question. I'll go ahead and read it, Sarah. I know you said, but it's on the mortgage-backed securities at this level. We are in uncharted territory. Is this why funds like BlackRock are buying real estate houses in large quantities? That is a good question. I don't know the exact reason why you see, like BlackRock. I know a personal thing. We usually love to vacation up around Winter Park and Fraser, Colorado area. And there's this specific area right in between Fraser and Winter Park. It's called the Rendezvous. And back in the financial crisis, a bunch of those homes got purchased. And then all of a sudden here about, I don't know, I think it was like right before the pandemic and during the pandemic, a whole slug of those houses came onto the market, and it was Berkshire Hathaway that bought them all. So is it a reason like these big investment groups are going out buying because the Fed has mortgage-backed securities? I don't know if it's the reason for it, but it certainly helps, right? It provides liquidity to that marketplace. Again, I mean, the Fed is picking an industry, and so there's money to be had there. And companies like BlackRock and Berkshire Hathaway are taking advantage of it. Another question: Agland has appreciated for the last 70 years at about 5% per year on average. Do you think the next 70 years appreciation will be higher or lower than 5%? Well, a 70-year average of 5% is pretty good. And they're not making any additional amount of farmland, or at least not yet. Maybe we'll figure out a way to do vertical farming at a really efficient clip. I mean, I guess that's possible. I would say, if I was to bet, probably say it'll be 5% again. But you could always, put it being higher. I mean, I think agriculture is always going to be a very appealing industry, no matter what's going on. We all need to eat, and it's a safe investment. A 5% return over that amount of time isn't, going to get investment bankers really excited. But it is a good, solid, safe investment that, weathers downturns and upturns pretty well. So if I was to guess, I'd say it'd probably be about 5%. All right, Sarah, I want to be mindful of the time. So do you want me to make this the last question?
That would be fantastic.
Okay. if inflation is slowed significantly, what impact will that have on land values? If we saw, like, if we did go into, maybe there was something the thing that would slow inflation significantly would be some sort of recession. And I'm not talking, like a pandemic type recession. I'm talking something that's more structural. What we had in the financial crisis, the real estate market collapsed. So if we had something like that, whether it's sovereign debt, like a sovereign country really defaulted on their debt and it created a global financial crisis, that would be something I think would really slow inflation. Now, what would that have impact on land values? If we look back over time, ag does pretty well during those times, actually. We see those lower interest rates, people again start to scramble and look for safer investments. And real estate, especially agricultural real estate, farmland, is an appealing one. So I wouldn't expect land values to go down. Maybe kind of start to plateau on all, and then potentially could go up. That would be my expectation if we really saw inflation slow significantly. But anyway, thank you all very much. Appreciate it. It's fun to do these webinars and share some thoughts. So with that, I'll turn it over to Sarah.
Thank you, Dr. Briggeman. I am hopefully advancing in my slides. Here we go. Okay, so I know many of you are MAB students and MAB alum, but if you know anyone interested in pursuing their MAB, if you are interested in pursuing an MAB, or just want to have some time to share your perspective with us, you can visit our website at mab.ksu.edu and choose a time that works best with your schedule. The schedule your advising appointment link takes you straight to Deborah Cole, our wonderful managing director's calendar. And we would love to chat with you via Zoom. Our next webinar is on July 12th. That is also with Deborah. It is an information webinar for our prospective students from noon to 1 p.m. Central. Again, that's on July 12th. And our second webinar in July is on July 26th with Dr. Nathan Hendricks and graduate student Micah Cameron Harp will talk to us about carbon credits. Feel free to invite others who you think would benefit from these two live webinars. And lastly, we would love to connect with you all through social media. Our students and alumni are very active on our channels, and we find it's a great way to start meeting others who've done the MAB and to stay connected with those throughout the ag business industry. Thank you all for joining us today. Have a great remainder of your day.